Did you know Nevada's housing market could be on the verge of its biggest collapse since 2008? If you think prices are just cooling off, think again. The latest data shows that by 2026, hundreds of billions of dollars in home equity could vanish, leaving hundreds of thousands of homeowners in financial ruin. And very few are prepared for what's coming. Las Vegas, Reno, Henderson, cities once celebrated for rapid growth, are now facing a perfect storm. Water shortages, hidden unemployment rising faster than reported, a wave of California residents returning home, and institutional investors quietly selling off massive portfolios are all converging at once. This isn't speculation. These are numbers, projections, and actions happening right now. In the next few minutes, I'll show you exactly why Reno's home prices could drop by 40%, Las Vegas by 50%, and Henderson, the so-called safe market, may face the steepest declines of all. I'll also reveal how major investors are positioning themselves to profit while everyday homeowners are at risk. These aren't theories. They're confirmed trends and statistics you won't hear on mainstream media. If you own a home, are thinking about buying, or simply want to understand what's coming, you need to watch closely. By the end of this video, you'll understand not just the scale of the risk, but also how to protect your assets, or even take advantage of the once-in-a-generation opportunities that will emerge. Nevada 2026 isn't just another market correction. It's a convergence of crises that could reshape the state's real estate landscape forever. And the clock is ticking faster than most people realize. Nevada housing market overview. Nevada, long regarded as one of the most active real estate markets in the United States, is experiencing notable shifts in 2025. After several years of rapid price increases, the latest data shows the market is beginning to slow down, signaling caution for both buyers and investors. Firstly, the median home price in Nevada is around $465,500, representing a slight 0.72% decrease compared to the same period last year. While this may seem minor, it is a critical signal. After years of continuous growth, the slight decline indicates that buyer demand is weakening, and consumers are approaching the market more cautiously. Experts note that this drop reflects the impact of higher mortgage interest rates and changing consumer sentiment following a period of housing boom. Another key factor is inventory levels, which currently stand at 19,674 homes, up 27.3% from the same period last year. The significant increase in inventory shows that supply is starting to outpace demand. As sellers are no longer in a rush and potential buyers remain cautious, homes are staying on the market longer, creating a more balanced environment and even giving an edge to buyers. This trend is also reflected in the average time to sell a home, now 55 days, up from 41 days the previous year. This figure indicates that transactions are no longer happening as quickly as during the market peak, giving buyers more options, while sellers may face longer wait times and may need to adjust prices to attract interest. Overall, the general trend in Nevada's housing market is slowing, with both prices and transactions showing signs of stabilization, but also some underlying risk. Buyers are exercising caution, carefully weighing their decisions, while sellers are adjusting their price expectations. The notable rise in inventory and longer selling times signal that the market may enter a broader adjustment phase in the coming months. In this context, factors such as interest rates, lending policies, and migration trends will play a decisive role in market stability. Understanding these indicators can help buyers, sellers, and investors make smarter decisions in a rapidly changing market. Nevada is no longer a hot market. Instead, it is moving into a phase of balance and caution where every financial decision needs careful consideration. Las Vegas housing market. Las Vegas, long celebrated for its rapid real estate growth, is now showing clear signs of cooling down in 2025. After years of soaring prices and high demand, the market dynamics are shifting, signaling both challenges and opportunities for buyers, sellers, and investors. One of the most notable trends is the decline in home sales, which have fallen by 10.2% compared to the previous year. This decrease indicates that the pool of active buyers is shrinking, largely due to higher mortgage rates, increased living costs, and a growing sense of caution among potential homeowners. While demand remains present, it is no longer the frenzied pace seen during the peak years of 2020 to 2022. At the same time, inventory levels have risen sharply, increasing 44.8% year-over-year. This surge in available homes provides buyers with more choices but creates downward pressure on prices, as sellers now face more competition. Homes are staying on the market longer, reflecting a transition from a seller's market to a more balanced environment. In fact, the average time to sell a property has increased by 15 days, signaling that sellers can no longer expect rapid transactions and may need to adjust expectations to close deals. Price adjustments are also becoming more evident. Recent data shows that the actual sale price is, on average, 4% below the original listing price. This may seem modest, but it marks a shift from previous years when homes often sold at or above asking prices within days of listing. Buyers now have room to negotiate, and sellers who fail to price competitively may experience extended time on the market. Investor activity in Las Vegas is another key factor shaping the current market. While large institutional investors have slowed down their purchasing pace, they still hold a significant share of the local housing market. Their presence helps maintain relative price stability despite cooling trends, but it also means that any sudden change in investor behavior, such as mass liquidation of properties, could trigger sharper declines. These investors are carefully monitoring the market, balancing risk with the potential for medium-term gains. Overall, Las Vegas is transitioning into a phase of market moderation. The combination of slowing sales, rising inventory, and moderate price adjustments indicates that the city is moving away from the explosive growth of the last several years. Buyers now have more leverage, while sellers must be strategic about pricing and timing. Meanwhile, institutional investors continue to influence market trends, providing a stabilizing effect even as local economic and demographic factors shift. For those monitoring the Las Vegas market, understanding these dynamics is critical. The slowdown is not yet a collapse, but it is a clear signal that the era of rapid, effortless appreciation has ended. Anyone looking to buy, sell, or invest must navigate a market that rewards patience, careful analysis, and a readiness to act when opportunities arise. Las Vegas in 2025 is a market in transition, balancing caution with opportunity. Reno and Northern Nevada housing market. Reno and the broader Northern Nevada region, long seen as a hub for tech-driven growth and out-of-state migration, are now showing clear signs of moderation in 2025. After several years of rapid home price appreciation fueled by demand from California transplants and tech-related employment, the market dynamics are shifting, offering both opportunities and challenges for buyers and sellers alike. The average listing price in Reno currently stands at approximately $538,184, representing a slight 0.67% decline compared to the previous year. While the reduction is modest, it marks an important inflection point. After years of double-digit annual growth, any decrease signals that the market is beginning to normalize. Sellers who priced aggressively in the past may need to adjust expectations, and buyers are starting to recognize that the market is no longer an upward-only trajectory. A key factor influencing the Reno market is the increase in inventory, which has risen 37.6% year-over-year. This surge provides buyers with more options and greater leverage in negotiations. Unlike the hyper-competitive environment of previous years, when multiple offers often drove prices above listing, today's buyers can take time to compare properties, assess value, and negotiate better deals. Higher inventory is helping to balance supply and demand, reducing pressure on home prices and creating a more stable market environment. This shift in inventory and supply has also translated into stronger bargaining power for buyers. Homes are staying on the market longer, and price adjustments are increasingly common. Sellers who are motivated or who fail to price competitively may experience extended listing periods. In contrast, buyers who are prepared to act strategically can secure favorable terms, including concessions, reduced prices, or incentives. The Reno market is transitioning from a hot seller's market to a more balanced market where both sides must approach transactions with careful consideration. Investor activity continues to play a significant role in Northern Nevada. Institutional buyers, who fueled part of the previous boom, have slowed down purchases but still maintain substantial holdings. Their measured approach contributes to relative price stability, but any sudden shifts, such as large-scale selling or repositioning of portfolios, could impact market dynamics quickly. Local economic factors, including tech sector layoffs, shifts in manufacturing, and changes in migration patterns, also add layers of complexity that both buyers and sellers must monitor closely. Overall, Reno and Northern Nevada are experiencing a market evolution. The combination of slightly declining prices, increased inventory, and improved buyer leverage indicates a transition from an overheated market to one that is more stable and sustainable. While opportunities exist for buyers to secure favorable deals, sellers must remain realistic and strategic in pricing. Understanding these market trends is crucial for anyone navigating Northern Nevada's housing landscape. In summary, Reno and the broader Northern Nevada region are entering a phase of moderation and balance. Buyers have more choice and negotiating power, sellers face new pricing pressures, and institutional investors continue to influence market stability. The rapid appreciation of previous years has slowed, but the market remains dynamic, requiring both caution and strategic action for anyone involved in Northern Nevada real estate. Key risk factors in Nevada's housing market. Nevada's housing market is currently facing a convergence of risks that could significantly affect home values, buyer behavior, and overall economic stability in 2026. While the general market data shows slowing growth and increased inventory, several underlying risk factors pose serious threats that are not immediately visible to most homeowners or potential buyers. Understanding these risks is critical for anyone involved in Nevada real estate. 1. Water crisis and lake mead shortages. The most pressing and long-term risk comes from Nevada's water supply crisis, particularly the conditions at Lake Mead. The reservoir, which is crucial for providing water to southern Nevada, including Las Vegas, is currently at historically low levels. Recent measurements show that water levels are approaching record lows, creating serious concerns about sustainability. Federal internal projections, though not widely publicized, indicate that mandatory water cuts of up to 35% could be implemented by 2026 if levels continue to drop. The implications for homeowners and investors are severe. Properties in areas with reduced water access may face dramatic declines in value, as water scarcity directly affects livability, landscaping, and overall desirability. Moreover, insurance companies have already begun to adjust their policies and premiums in anticipation of these shortages, with some major providers pulling back from high-risk areas entirely. Homes without reliable water access or adequate coverage may become effectively unsellable, creating a ripple effect across the local real estate market. 2. Hidden unemployment pressures. Another less visible but significant risk comes from the hidden unemployment that may escalate due to automation and corporate restructuring. Large employers such as Amazon and Walmart are increasingly investing in automation, with plans to reduce tens of thousands of positions over the next year. For example, Amazon's Henderson fulfillment centers are implementing robotics that could replace thousands of employees, while Walmart is expanding automated checkout systems and inventory management technologies. These reductions are not just theoretical, they are approved, ongoing plans. Coupled with Nevada's current labor dynamics, including high numbers of gig economy workers and part-time employees seeking full-time positions, the true unemployment rate could be far higher than official reports suggest. The state's unemployment insurance fund currently holds only limited reserves, which could be exhausted quickly if job losses accelerate. This creates the potential for a cascade of mortgage defaults, as unemployed workers struggle to meet housing payments, mirroring patterns seen in other economic downturns such as the 2008 financial crisis. 3. Reverse migration from California. A particularly unexpected factor influencing Nevada's housing market is the reverse migration of California residents. Recent policies in California, including relocation incentives and tax adjustments, are encouraging former residents to return to the state. Some programs are offering financial incentives of up to $50,000 for Californians to move back, targeting residents who relocated to Nevada, Arizona, and Texas in recent years. This trend has direct implications for housing supply and pricing in Nevada. Many of the returning residents are selling their Nevada homes, often at a loss, in order to take advantage of California's incentives. This increases the supply of homes for sale in Nevada just as demand is softening, putting downward pressure on prices. The influx of distressed sellers, combined with limited new buyer activity, could trigger a rapid adjustment in home values, particularly in cities like Las Vegas, Henderson, and Reno that were previously buoyed by high California migration. 4. Short-term rental market vulnerabilities. Nevada, particularly Las Vegas, has a high concentration of Airbnb and short-term rental properties, with over 67,000 units statewide. These properties were heavily reliant on tourism and conventions, sectors that are now facing declining demand due to economic pressures, remote work trends, and changes in travel behavior. Recent data indicates that Airbnb revenues per property have dropped 40 to 45% from peak levels, while occupancy rates have fallen significantly. Many investors are now operating at a loss, with some reporting negative cash flow of over $1,000 per month per property. As losses mount, institutional and individual investors may be forced to liquidate properties, flooding the market and exacerbating price declines. Regulatory changes in Clark County and other jurisdictions, such as limits on short-term rental days, further constrain revenue potential, making the market even less sustainable. 5. Insurance and construction defect risks. Finally, Nevada homeowners are facing a combination of rising insurance costs and construction-related risks. Home insurance premiums have increased dramatically in the past 18 months, with some high-risk areas seeing hikes of 60 to 70%. In addition, several major insurers have stopped writing new policies in certain regions, making it difficult for buyers to secure financing. Without insurance, mortgages cannot be issued, creating an additional pressure point in the housing market. Construction defects are also becoming a serious concern. Homes built during the 2020 to 2023 boom were constructed at record pace, often with cut corners, inexperienced labor, and substandard materials. Independent inspections reveal that a significant portion of these homes, up to 40%, may experience structural issues such as foundation failures, water intrusion, or other major defects within the next few years. The combination of costly repairs, legal disputes, and insurance challenges amplifies financial risk for homeowners and investors alike. Conclusion: the convergence of these 5 risk factors, water scarcity, hidden unemployment, reverse migration from California, short-term rental losses, and insurance/construction challenges, creates a unique and high-stakes environment for Nevada's housing market. While the market is not collapsing yet, these underlying pressures suggest that 2026 could mark a turning point, with widespread price adjustments, distressed sales, and potential financial strain for homeowners and investors alike. For anyone participating in Nevada real estate, whether buying, selling, or investing, understanding these risks is crucial. Careful planning, market monitoring, and strategic decision-making will be key to navigating what could be the most challenging period the state has faced in decades. 2026 forecast: the critical turning point. Experts increasingly point to 2026 as a critical convergence year for Nevada's housing market, where multiple risk factors align to create unprecedented pressure on homeowners, investors, and the broader economy. Unlike previous slowdowns, this potential downturn is driven not by a single issue, but by the simultaneous occurrence of several structural challenges, which collectively could trigger a sharp market adjustment. 1. Commercial real estate debt maturities. One of the primary stressors is the billions of dollars in commercial real estate loans maturing in 2026. Many properties, purchased or leveraged during the post-pandemic boom, are now valued significantly below their outstanding loan balances. Analysts estimate that $47 billion in commercial loans could face refinancing pressures. If lenders demand repayment or borrowers default, the ripple effect could constrict credit availability, reducing investment in both commercial and residential markets. The result: a liquidity squeeze that mirrors the prelude to previous real estate crises. 2. Federal infrastructure projects ending. Another key factor is the completion of federal infrastructure spending projects, which have been supporting tens of thousands of construction jobs across Nevada. By the first quarter of 2026, many of these projects are expected to conclude, resulting in the sudden loss of approximately 31,000 construction-related jobs. For local economies, this reduction will have a multiplier effect. Fewer employed residents mean decreased consumer spending, slower economic growth, and additional downward pressure on housing demand. 3. Adjustable rate mortgage, ARM, resets. A further challenge is the adjustment of ARM mortgages, which are scheduled to peak in mid-2026. For homeowners with adjustable loans, these resets could increase monthly payments by an average of $1,450, forcing many to either sell or struggle with unaffordable mortgage obligations. Given the already slowing market, large numbers of forced sales could flood the market with inventory, accelerating price declines and creating a buyer's market dominated by distressed sales. 4. State budget shortfalls. Nevada's fiscal situation also compounds the risk. Projected state budget deficits are expected to hit approximately $2.3 billion due to declining revenue from gaming taxes, tourism, and other economic drivers. The shortfall may force cuts to public services, layoffs of state employees, and reductions in programs that support housing stability. Combined with reduced consumer confidence and rising costs, these fiscal constraints add another layer of pressure on housing demand and market stability. 5. Water crisis triggering localized collapses. Perhaps the most critical risk is the ongoing water crisis, particularly in southern Nevada. If Lake Mead and other reservoirs reach legally defined critical levels, certain zones may face emergency water restrictions. Homes in these areas could become nearly unsellable, as buyers and investors are reluctant to purchase properties without reliable water access. This localized collapse can have a broader psychological effect on the market, undermining confidence even in areas less directly impacted. Conclusion. In summary, 2026 represents a convergence of multiple high-stakes risk factors: commercial debt maturities, the end of federal construction projects, our mortgage resets, state budget deficits, and water scarcity. Individually, each factor would strain the housing market. Together, they create a scenario where market corrections could be rapid, deep, and widespread. For homeowners, investors, and policymakers, the key takeaway is that strategic preparation is essential. Monitoring financial exposure, assessing property risk, and understanding market dynamics are no longer optional. They are critical for survival in what could be the most challenging year for Nevada real estate in decades. Regional impact zones. The effects of Nevada's housing downturn will not be uniform. Different regions face distinct vulnerabilities based on demographics, economic drivers, and market composition. While all areas are exposed to the overarching risks of 2026, the degree and nature of the impact will vary significantly. Northern Nevada, Reno. Reno is expected to experience a 40 to 45% decline in home prices, primarily due to the sharp disconnect between local incomes and housing costs. For years, Reno's market has been fueled by in-migration from California and a booming technology and logistics sector. However, the median home price, currently hovering around $538,000, is more than 7 times the average household income in Washoe County. This affordability gap leaves local buyers unable to support current price levels once investor enthusiasm fades. As job growth slows and inventory rises, Reno's market will likely see a rapid correction. Wealthier buyers may retreat, while middle-class families face stricter credit conditions, leading to a sharp fall in transaction volumes. The city's reliance on tech-driven expansions also creates vulnerability to layoffs if national or global slowdowns occur. Las Vegas. Las Vegas, Nevada's largest housing market, could face the steepest decline, 40% to 50% in home values. Unlike Reno, the city's economy is deeply tied to consumer spending and tourism, both of which are highly cyclical. A slowdown in tourism, combined with potential job losses from the end of federal projects and automation in major employers, will directly hit household incomes and housing demand. Investor-driven purchases, particularly in suburban developments, magnify this vulnerability. If rental yields fall or Airbnb revenues continue to decline, large-scale investor liquidations could overwhelm the market with supply. Historically, Las Vegas has been one of the first cities to collapse in national downturns, and the same pattern appears to be forming again. Henderson and Summerlin. The affluent suburbs of Henderson and Summerlin, often marketed as luxury safe havens, are not immune. On the contrary, they may suffer some of the sharpest localized price drops due to California reverse migration. Many residents in these areas are former Californians who moved to Nevada for lower taxes and cost of living. However, as California introduces incentives for return migration and remote work trends shift, some of these homeowners are expected to sell off their Nevada properties. This dynamic could trigger distressed sales and sudden oversupply in markets that were once considered resilient. Luxury and high-end segments typically have fewer buyers even in stable times, so a flood of listings could cause values in these neighborhoods to fall more dramatically than in mid-market areas. Rural Nevada. Rural communities, while less exposed to tourism volatility, will still face significant challenges. Home prices here may decline 20 to 25%, driven mainly by credit contraction rather than local economic collapse. With fewer local lenders and limited access to capital, rural buyers may find it harder to secure mortgages. Additionally, outmigration from rural areas could accelerate as residents move toward larger cities in search of employment, further reducing demand. While the decline may not be as severe as in urban centers, the recovery will likely be slower due to weaker job creation and lower population growth. Conclusion. In short, Nevada's housing correction will not strike evenly. Reno and Las Vegas face severe affordability and economic pressures. Henderson and Summerlin risk luxury oversupply, and rural Nevada contends with credit scarcity and demographic headwinds. Each region's unique vulnerabilities will shape the depth and duration of the downturn, but the common thread is clear. No part of Nevada will escape unscathed in 2020 SIXS housing reset. Investor and buyer trends. The evolving dynamics of Nevada's housing market are shaped not only by macroeconomic forces, but also by the behavior of investors and homebuyers. As 2026 approaches, clear signs show that both groups are retreating or repositioning, a shift that could accelerate price corrections across the state. Institutional investors, from buyers to sellers. For much of the past decade, large institutional investors and private equity funds have played an outsized role in Nevada's housing market. These entities, flush with capital, acquired thousands of single-family homes, often outbidding local buyers and converting properties into rentals or short-term listings. Their activity helped prop up prices and contributed to Nevada's affordability crisis. Now, the cycle is reversing. Many of these firms are preparing to liquidate portions of their portfolios. Rising maintenance costs, higher insurance premiums, and declining rental yields, particularly in markets like Las Vegas where Airbnb revenues are falling, are eroding profit margins. Once a handful of large investors begin to offload inventory, others are likely to follow, creating a domino effect. A coordinated sell-off of thousands of units could overwhelm local demand, resulting in a sharp and sudden price drop that ripples across neighborhoods. First-time buyers disappearing. At the other end of the spectrum, first-time homebuyers have nearly vanished from Nevada's market. In Las Vegas, one of the hardest-hit regions, affordability has deteriorated to the point where a household must earn approximately $147,000 annually to comfortably purchase a median-priced home. Only about 11% of households meet this income threshold. This leaves a vast majority of young families and working-class residents locked out of homeownership. Historically, first-time buyers are critical to sustaining market momentum. They generate demand at the lower tiers, enabling existing homeowners to move up. Without them, the housing ladder breaks. The absence of this demographic is not just a temporary setback. It signals a structural weakness that could prevent the market from rebounding quickly, even after prices decline. Demographic shifts and aging population. Another challenge comes from Nevada's shifting demographics. The state's retiree population is expanding at a faster rate than its working-age population, a trend that is especially visible in communities like Henderson and Summerlin. As retirees downsize or liquidate homes to fund retirement, more inventory enters the market. Yet, with fewer younger households able to buy, the imbalance between supply and demand grows. This generational mismatch is particularly concerning because it reduces long-term stability. An older seller-heavy market with fewer qualified buyers sets the stage for prolonged price stagnation or decline. Unless in-migration of younger, higher-income households resumes at scale, Nevada's housing demand will continue to erode over time. Conclusion. The convergence of these trends, institutional sell-offs, the disappearance of first-time buyers, and demographic imbalances, creates a feedback loop that intensifies downward pressure on Nevada's housing market. Investors once seen as stabilizers are now potential disruptors. Younger households that traditionally fuel growth are sidelined by affordability barriers. Retirees, once reliable anchors of the market, are increasingly becoming net sellers. Together, these shifts signal a housing market entering a phase of fragility, where demand erosion meets supply acceleration, pushing Nevada closer to a tipping point. Conclusion and action plan. Nevada's housing market stands on the edge of a profound reckoning. What is unfolding is not merely a cyclical correction, but a potential systemic collapse that could erase hundreds of billions of dollars in home equity. Unlike past downturns driven by isolated shocks, this crisis is fueled by the convergence of debt maturities, affordability breakdowns, demographic shifts, and environmental pressures. Together, these forces create the conditions for a prolonged and painful reset in 2026 and beyond. For homeowners, current homeowners face the most immediate risk. Rising interest rates, falling demand, and looming investor sell-off suggest that price stability cannot be taken for granted. For those who purchased during the post-pandemic surge, equity cushions are already thin. If market declines accelerate as forecasted, many households could find themselves underwater on their mortgages. The prudent course of action for at-risk homeowners is to seriously evaluate selling before 2026. While no one can time the market perfectly, offloading a property while values remain relatively stable may prevent catastrophic losses later. Even if selling now means accepting a modest discount compared to peak pricing, it may ultimately preserve wealth in the face of a much steeper collapse. For prospective buyers, particularly those without urgent housing needs, patience will be the most valuable strategy. The affordability crisis currently makes ownership unattainable for the majority of households, but the downturn of 2026 to 2027 may create rare opportunities. As forced sales, investor liquidations, and demographic-driven supply hit the market, deep discounts will likely emerge, but primarily for cash buyers. Those relying on conventional financing could still face barriers as banks tighten lending standards during downturns. Conversely, buyers with liquidity and the ability to purchase outright will hold a distinct advantage. For them, the next 2 years may represent a once-in-a-generation chance to acquire property at a fraction of today's prices. For policymakers, the question of whether government intervention can soften the blow remains uncertain. Nevada's ability to act is constrained by state-level resource limitations, while at the federal level, ballooning national debt restricts room for large-scale housing bailouts. Previous crisis-era programs, such as mortgage relief or foreclosure moratoriums, may not be politically or fiscally feasible this time. Without significant external support, Nevada is left to navigate this downturn with limited tools, placing greater responsibility on individual decision-making. Homeowners, investors, and buyers cannot count on government programs to provide a safety net in the event of a systemic housing collapse. Final takeaway. The coming years demand a shift in mindset. The Nevada housing market is not entering a temporary slowdown, but a potential structural reset. For sellers, the key is urgency, acting before the tipping point arrives. For buyers, the key is patience, waiting for the flood of discounted opportunities. For policymakers, the challenge lies in mitigating fallout with limited resources. In short, survival in Nevada's real estate market will depend less on optimism and more on strategic preparation, realism, and decisive action.